The Federal Reserve just delivered its first decision under Chair Kevin Warsh, and the message is unmistakable. The era of expecting rate cuts is over. Let me walk you through exactly what happened, what the market did in response, and what this means for the next 3 months. The FOMC voted unanimously to hold the federal funds rate at 3.50 to 3.75%. That was the least surprising part of the day. The CME FedWatch had priced a hold at 97%. What mattered was everything else. First, the dot plot. The March 2026 summary of economic projections still showed a median of 1 cut for 2026. That is gone. The June dot plot shows at least 3 committee members now projecting rate hikes before year-end. Bank of America's analysis confirms the median has shifted from cuts to a clear tightening bias. Half of the FOMC now projects at least 1 rate hike in 2026. The previous easing bias language has been removed from the statement entirely. Second, Kevin Warsh used his first press conference to signal a break from the Powell era. The statement itself was unusually short. No forward guidance, no detailed assessment of risks. Warsh announced the creation of 5 task forces to examine Federal Reserve operations, including one focused on the communication framework itself. He declined to submit a dot of his own to the projections, signaling he wants to reshape how the Fed communicates its rate path. For a market that has spent 2 years parsing every word of FOMC statements, this silence is itself a signal. Third, the economic projections behind the dots confirm the stagflation picture. GDP growth was revised down from the March estimate. Inflation was revised up. The Fed is acknowledging slower growth alongside sticky inflation, even if they did not use the word stagflation. Now here's how the market reacted. And this is where the story gets interesting. Equities sold off after the decision and press conference. The S&P 500 closed at approximately 7,405, down 1.42% from Tuesday's close of 7,512. The Nasdaq Composite fell 1.3%, and the Dow Jones Industrial Average dropped about 1% after earlier hitting a fresh all-time intraday high, its 3rd consecutive record. The Dow had been up as much as 0.5% before the press conference. The reversal was sharp. The Russell 2000 gave back earlier gains and closed essentially flat at plus 0.24%. Small caps could not hold their pre-FOMC momentum. The sector rotation told the real story. The Magnificent Seven led the losses. Meta, Microsoft, Alphabet, and Amazon each dropped more than 2%. The Nasdaq 100 fell 0.4% on the headline, but deepened through the afternoon. Growth stocks are the most sensitive to a hawkish repricing of the rate path, and they reacted accordingly. But here is the counterintuitive move. Semiconductor stocks extended their rally. Micron, Marvell, Applied Materials, and Intel all added more than 3%. The chip sector is decoupling from the macro narrative and trading on its own AI-driven fundamentals. That is a signal worth watching. The bond market reaction was relatively contained. The 10-year Treasury yield held near 4.44%. Essentially unchanged. The 2-year yield was at 4.05%. The curve inversion has flattened significantly, down to about 39 basis points from the 50-plus basis point inversion we saw in May. The bond market is repricing the path of rates, but not panicking. The VIX rose 3.3% to 16.95, elevated relative to the pre-Iran war levels, but not spiking. This was a repricing, not a crash. Now let me cover the event that happened alongside the Fed, but was overshadowed by it. The U.S. and Iran are set to formally sign their interim peace agreement on Friday in Geneva. The 14-point draft memorandum was published by Bloomberg on Tuesday evening. The terms are significant. Iran will reopen the Strait of Hormuz and resume oil exports immediately. Iran receives a $300 billion redevelopment fund from the U.S. and its allies. The strait is to return to pre-war traffic levels within 30 days. Oil has already collapsed on this news. WTI crude closed Tuesday at $75.82 a barrel, down 6.1% in a single session, and continued lower on Wednesday as the signing date was confirmed. Brent crude is below $78. The war premium that had built up since February is being unwound rapidly. But here is the risk the market is not fully pricing. U.S. intelligence agencies reportedly assess that Iran retains the ability to shut the Strait of Hormuz at will, regardless of the signed agreement. President Trump himself said Wednesday that the memorandum is not final. The deal signing on Friday is not the end of the story. It is the beginning of the next phase. SpaceX had another extraordinary day. After surging 20% on Tuesday following the $60 billion acquisition of AI coding startup Cursor, SpaceX continued to climb. The stock closed at $201.80 on Tuesday, up from $192.50 the prior day, after hitting an intraday high of $225.64. SpaceX's market cap has now surpassed Amazon's at over $2.9 trillion. The Defiance 2X long SpaceX ETF began trading this week. SPCX options launched on Tuesday. The stock has gained roughly 50% since its IPO price of $135 on June 12th. The economic data released Wednesday morning added to the stagflation picture. May housing starts slumped 15.4% month-over-month to 1.177 million annualized, the weakest since 2020 and below every economist estimate. Multifamily starts collapsed 40.2%. Building permits fell 0.7%. Import prices rose 1.9% month-over-month, well above consensus, with the annual rate at 6.7%. Export prices rose 1.3%, and May retail sales rose 0.9%, beating the 0.6% estimate. Consumer spending is holding up even as housing craters. Here is what I'm watching going forward. First, the Iran deal signing on Friday. If it goes through as announced, oil has further downside to $70. If it stalls or Trump walks away, oil bounces hard and the market reprices the war premium all over again. Second, Warsh's September meeting. The dot plot signals at least 3 members want a hike. If the next CPI print comes in above 4%, those 3 become 4 or 5. The market needs to start pricing a realistic probability of a hike at the September 29th to 30th FOMC meeting. Third, the housing data. A 15.4% drop in housing starts is recession-level data. The market is ignoring it because the consumer is still spending. That divergence cannot persist forever. Fourth, SpaceX. The stock has gone from 135 to over 200 in 4 trading days. The Cursor acquisition adds AI revenue, but also adds 3.4% dilution. Options volume on day 1 was the 5th highest on record. This stock is now a volatility vehicle, and the lockup expirations in September will determine whether the rally is structural or speculative. The framework for the next month is defined. The Fed has confirmed it will not cut. It has opened the door to a hike. The Iran deal is unwinding the energy shock. Housing is collapsing. The consumer is still spending. And SpaceX is trading like a meme stock with a $3 trillion market cap. Trade the range. S&P 500 support at 7,200. Resistance at 7,500, the level that held before the FOMC. A break below support puts 7,000 in play. A break above resistance requires either a clean Iran signing or a dovish pivot from Warsh. Neither is the base case. Watch the dot plot dissenters, watch the straight, and watch the housing data. Those 3 variables will dictate whether this is a garden variety consolidation or the beginning of a larger repricing. I am Daniel Reed. Keep your data sharp and your logic sharper.